Welcome back to the Wealth Channel. I'm Associate Dean Alan McClellan. It's my pleasure to be joined again today by fellow professors Ted Kurlowich, Chris Worley, our Dean and Professor of Investments Walt Werheide, and Craig Lemoyne. Last week we started our discussion of the impact of this new law that extended the Bush-era tax cuts, and I'd just simply like to pick up there where we left off. Craig, from a financial planning standpoint, are there any actions that clients, for example, could be doing in the next 2 years to take advantage of this patch?
Well, certainly if you are of the mindset that it may go away, not following the thought that it would stay. Talk from advisors, talk to your clients, get to know what AMT preference items are. If they have some incentive stock options, now may be the time to take advantage of that. Some types of charitable deductions, and I'm sure my colleagues can speak a little more on AMT preference items, a little more depth than I can. But ensure that your clients, if they're in that middle ground, if they're in that patchwork ground, go ahead and take advantage of exercise your options. Maybe a year early, maybe it's not the best price, but at least you're saving yourself from the potential of AMT down the road, and maybe you could talk a little bit more about some of the other preference items clients could take advantage of.
Well, thanks to the late Daniel Patrick Moynihan in the early 1990s, the appreciation on stock that were contributed to charity is not a tax preference item. And that still continues to be the case. I think the AMT also represents a fundamental choice the people through their representatives have to make. You could have a system where there's not the need for an alternative minimum tax.
You could, certainly.
But the people through their representatives decide we want to try to create systems that have preferences. I always take some umbrage when people say, well, that's, quote, a special interest. Well, every organization or group of citizens, they have the right to petition the Congress and act as they see their interest is fit. So one person's special interest might be another's necessary expenditure. We've had the mortgage interest expense. We've tried to taxpayers fairly to allow for the fact some are in higher tax states than lower tax states. Is that a special interest, or are you actually trying to measure income?
Let's go back and hit on something that we just briefly touched on, and that is toward the end of the year, there was a lot of talk about a huge sell-off of the stock market, for example, if the capital gains rates had risen. And that was one of the, you might say, pressure points to Congress to pass the law in the midst of still a very struggling economy. So going forward for the next 2 years, what sort of strategies might we think about or for our clients if we assume, for example, that those capital gains and dividends rates might go back up at the end of the 2 years?
Well, what comes to mind off the bat, and if we're going to be in a situation to need income, maybe we buck the trend and we pull out some long-term capital gains first. That could be an option. Additionally, to prepare. If we assume a market sell-off in a couple of years, right, then we may assume an artificial inflated value today, maybe some arbitrage, maybe locking that into a tax-deferred product, a non-qualified deferred annuity of some sort, would protect that client when you did have some downturn.
I'm not as convinced that that there would be a huge sell-off for several reasons. Number one, a significant amount of securities in this country are owned by tax-exempt institutions. So they could not care less about what happens to the long-term capital gains tax rate or the dividend tax rate. So they're not affected. B, if people are adjusting their portfolio based on taking the capital gains before the rate goes up, you have to think about, well, what are they going to do with that cash? So if it's purely a tax move, I don't think people making a tax move literally will take all that money out of the market. They're going to turn around and buy something else And I think that will tend to put a floor on that. And then C, you have the issue of that it really depends on your holding period. If you take a capital gain now on something you would have held for another 10 or 15 years, even if you sell it at a higher capital gains tax rate later, financially you may be worse off selling it today rather than holding another 15 years and paying the higher rate then. So, and to the extent a lot of people who are taxable are engaged in buy and hold strategies, it's not clear to me that they'll be rushing to liquidate to take advantage of the disappearing capital gains tax rate.
Well, let me survey the field here while we've got everyone. Just a quick answer. Where do you see tax rates 5 to 7 years into the future?
I think about the same.
Sadly, I think they will be higher.
Beyond the knowledge of mere mortals, this Congress and the prior ones have been amazingly unpredictable.
I think the correct phrase is above my pay grade.
Oh, okay. Above my pay grade.
You have a personal belief?
That is my personal belief. They've been spectacularly difficult to predict. If you had told me they would have let the federal estate tax expire, I would not have believed it. And right now, the culture in Washington right now is not optimal to deal making, notwithstanding the recent quote compromise. I think that was a compromise of convenience. Who's the party for high taxes? No one will ever admit that. Everyone wants a reduction in taxes.
Ted, what's your view?
I think the tax system itself is going to go through a major renovation. The ultimate result of it is the government will find a way to collect more revenue, but it may not look entirely the same as it looks today. We may not be talking about capital gains rates going up or dividend rates going up. We may have a slightly different tax structure, and there'll be some add-on taxes in a way that are more hidden from the average consumer and average taxpayer. Maybe a consumption or value-added tax placed in there. It's a great myth when people say that other countries have lower tax rates, as they don't. And many of these European cultures have a consumption or value-added tax in addition to the other layers of tax. So I think we're going to see a new regime of taxes where the government will collect more revenue. But I don't know that we'll be talking about the taxes as we have through this panel.
I could support that as a possibility. I do think, though, that part of any major tax reform is the benefits are broader and more dispersed and less apparent to the public. The pain through the loss of an exclusion or the denial of a deduction is more immediate and apparent. I think the challenge in our country with a value-added taxes would be, though, the very thing that a lot of people who propose it like. I don't think the political class may be as open to it in that it's transparent. I mean, if you're going to raise revenue, either you're going to have to expand covered services or products or raise the rate. And the other is, and this constituency will be heard from more because of their financial distress, the 50 states. Many of them are heavily reliant on sales taxes, so the imposition of that will have, there'll have to be some deal making to see if that goes. But I think, as Ted was suggesting, maybe other taxes. There's been talk about having a tax on transactions, and so much capital now flows freely, but we'll see.
Everyone, thanks for joining us today. I'm looking forward to picking up this conversation in our next segment. Join us next week when the expert panel continues their examination of the law extending the Bush-era tax cuts. I'm Alan McClellan, and thank you for joining the Wealth Channel.